How's that?
Can't see it. Here we go. Here we go. Oh, it's an advert. There we go. Skip that. And you're there.
Okay, so with any luck, people can see me. Okay, well, it's 8 o'clock. Am I visible? Yep, apparently so. Good. So this is a bit of an experiment for us because we've never done a YouTube Live before. But the purpose of this is so that other people can see exactly what we do during one of these Sunday evening calls, because I think it's hard to know until you've actually seen it to see whether it's of value to you. So remember, we don't give financial advice, we only give financial education, and the purpose of this is to answer questions which have been asked on Slack during the week. So that's what I'll be doing, and what I'll do is I'll pause after each question, and I'll let you ask questions, which I'll look into the into the streaming questions which are going past, and hopefully I'll be able to see the questions and answer them. So I realise I am competing with the Queen at the moment, which is not a good idea in the UK, but I know that some people are dialing in from, or at least looking at this from the US. So yeah, I guess you'd be less interested in watching the Queen in that case. So let me just switch to my desktop so that you can see what I'm talking about. So hopefully you can see both there, and you should be able to see the questions there. Is the screen visible? Should be visible shortly. Bit of a lag. Laura? Visible? Good. Okay. Right, so let's start with some news, which is that next week,
Yes.
so next week we're going to be talking about navigating your portfolio through the crisis. So this won't be answering patron questions. This will be answering questions live. I won't prepare for it at all. Well, other than a long time in the financial industry, and I'll answer your questions live. So that'll be next week on Saturday at 7 p.m. So just be aware that that will be happening. Laura, I think what I'll do is I'll share the link to this document, but I'll share it on Slack, so patrons will have access to it. Let me just copy that. And unfortunately, people who aren't patrons will not have access to it, but you'll be able to see me talking. So if you are a member, then you'll get access to that on the Slack channel. Okay, so let's start going through it. So 3 minutes past. The Queen will be finished in 2 minutes. So first question is about long duration government bonds, which have done very well in the recent turmoil, but I know that these can also be volatile due to the duration risk. Could you discuss or present a risk versus volatility plot for various bond types and duration? I'm thinking here of the US, UK and German government bonds, hedged and unhedged. So a frequently asked question which used to come up with clockwork regularity used to be whether it's worthwhile hedging a bond fund. Now, I'll demonstrate this with two examples. Now, iShares has two treasury bond funds which buy US government bonds in the 7 to 10 year maturity band. So these are US government bonds which will mature between 7 years from now and 10 years from now. Now, there are two versions of that fund. One of them is hedged into sterling and the other one's denominated in US dollars. So from the point of view of a UK investor, if sterling weakens, then the value of your US version will go up, but the hedge version will not be affected by sterling. And I've also got links to those in the document. So if you click on the link, it'll take you to the description on iShares website. So this is what the description looks like. And you can see this is the hedged version, which is IGTM. And the US dollar version is IBTM. But if you go down to the actual holdings, I won't show it here, but you'll see that the actual bonds which are held by the fund are identical. The weightings are the same, the bonds are the same. The only difference is the wrapper around it, which determines whether it's hedged or unhedged. So let's switch back to the document. And what I've done here is I've compared the two. So this, let me just zoom in so you can see this. IBTM is the unhedged one, and you can see that's outperformed the hedged one, and that's because of the weakening of sterling versus the US dollar. It's nothing to do with the difference in performance of US treasuries, because remember, they hold exactly the same bonds within the fund. So that very large outperformance is purely due to sterling weakening. So this is based on one pound invested at the end of the beginning of 2019. I think it was February the 27th, 2019. If you invest £1, this is what it would now be worth. So the key thing to understand is if you don't have a view about currency, there's just no point in taking the currency risk. The cost of the actual hedge is incorporated in the cost of the fund. And you'll see the unhedged one is 0.1% per year. It's very small because US treasuries are extremely liquid. And the hedged version is only 3 basis points, that's 0.03% more expensive. So these are the two management charges, so 0.07 and 0.1 for the hedged version. So the cost of the hedge is it's negligible. And if you don't have a view about currency, then it's probably better to hedge. And I'll show you why that's the case in a moment. If you do think sterling is going to weaken further versus the US dollar, then it makes no sense to hedge. In that case, you probably would leave it unhedged. And if you do think sterling is going to strengthen, well, that's going to hurt your US Treasury holding if it's unhedged. So then you would hedge. So no view, hedge it, probably. And I'll show you why. So the unhedged version has twice the volatility. In other words, the annual price movement, a typical price movement in 1 year of the unhedged version is about 12%. And that's dominated by the effect of sterling volatility, which was 11%. Whereas the hedged version has about half the volatility, 7.4%. So that's why it makes sense to hedge bond funds, because they have a much lower volatility. And so they get swamped by the currency volatility. So just be aware of that. And then if we look at the risk return plot, you can see that the risk is on the x-axis here. So high risk is on the right, high risk and low return, low risk and low return on the left. So low risk, high risk, and low return, high return. And what you can see is that the 7 to 10 year treasury, which is as unhedged, has a much higher volatility, but it also has a bit higher return, which is pretty much what we've seen already. This is what it looks like on the risk return plot. And I've got other risk return plots below, so I just wanted to set up what that risk return plot looks like. So high risk, high return up here, low risk, low return in the bottom left. So duration is pretty much the same trade-off as you have when you decide how much of your portfolio you put into equity and into bonds. The idea being that if you take more risk, you should expect to be compensated with a higher return. That's not always true, but it's usually true over a very long period of time. So longer duration for bonds also usually means you get a higher compensation over the long term, because normally the yield curve is kind of upward sloping, which means you get paid more for taking more duration risk. Unfortunately, longer duration also comes with higher volatility. So the price movements tend to be much bigger if you go for long duration funds. So to see what that looks like, I've got 3 of these iShares funds. The one at the bottom left, which is lowest risk and lowest return, only buys 1 to 3 year US Treasuries. So these will mature between 1 year and 3 years from now. So they're very short duration. That means the price volatility is very low and the risk is also very low. So low return, low risk. Intermediate risk is in the middle of the chart, and that's for 3 to 7 year US Treasuries. And then the high risk and higher return is a 7 to 10 year US Treasury fund. And this is based on returns between 2010 and last Friday. So longer duration, if you're investing for a longer period of time, you might think that it might be better to take more risk, because then you can potentially earn a higher return. It's a rough ride, but it's worth it if you can ride out the volatility. So looking at a wider range of funds, and I've plotted here many of the funds from iShares, which are fixed income funds. You can see that, for example, iShares Euro government bond funds, which are long duration, have been the best performers. But generally, the longer term funds have been the best performers over that period of time, and also the ones which are unhedged, because then the sterling weakening, which we've had, has acted as a tailwind for your fund. But there's no reason why it should resemble that in future. It's very difficult to know what will happen with the currency. But certainly the longer duration funds will have greater return because they usually have greater coupon. So that's what I'd say. Also, I've done a volatility plot so that you can see, so that you can see, you can compare those different funds according to their typical annual price moves. So this is volatility between September 2018 and last Friday. And you can see that the ones which are unhedged tend to be at the top because they're taking all of that currency fluctuation, and the long duration ones also tend to be higher risk. So those are the kind of rankings of risk. Now, when all markets become more volatile, all of these volatilities will increase, but usually the ranking is fairly similar. So the ones which are highest risk before, relative to the others, will remain highest risk relative to before, because volatility usually rises in all markets simultaneously. So think of this as a kind of risk ranking. You know, how does this fund compare to the risk of another fund? So let me go back to the live stream, see if there are any questions about that.
Increase the size of your screen.
Okay, I can't increase the size of my screen, unfortunately. A few weeks ago, you switched your Vanguard portfolio funds to government bonds for less volatility. Have you switched back to your original funds? No, I haven't. Let me just switch back to, I wonder if I can pop this out. Pop out chat. Yes, I can. Very good. So back to that and back to this. Okay, so I can see that now. Good. And let me just put okay, that should just be me. So no, I didn't switch my funds to. Whenever I change my portfolio, I kind of talk about it. So I haven't had any big changes. I put 20k into my ISA, but I haven't allocated it yet. So I haven't changed anything. I've de-risked, so I moved money out of credit and out of emerging market government bonds, and I've put it into UK Treasuries and US UK gilts and US Treasuries, and the US Treasuries are currency hedged. Then a few questions about recession. What do you think about investing today in Life Strategy 20? Is this asset allocation defensive enough for these troubled times? Life Strategy 20 is 80% bonds. Almost all, I think none of it is high yield. It's all either investment grade or government bonds. So that's certainly a very cautious portfolio. So yes, it's certainly cautious. Whether it's cautious enough, time will tell, I guess. But certainly among the 20 to 100% equity funds, it's the least risky one. So yeah, I mean, if you have to choose between one of those and you think that it's going to get worse before it gets better, then Life Strategy 20 is the appropriate one to hold. And my portfolio allocation currently is 20% equity too. Ivan Gorgiev says, I don't think Europe's looking that good now. I guess it's true globally at the moment, which is the whole world's been swept up in this. So, you know, we're all taking a very big hit in terms of growth, and there'll be a question about that further on. Have we hit a bottom in equities again? There's another question about that in a moment. Should we be careful on buying bonds now since they're at all-time high? So one thing about bonds is they're never unfairly priced, right? They have a low yield or a high yield, low coupon, high coupon, but they're always fairly priced. They always trade within very narrow bounds of their fundamental price, because there are very clear arbitrage trades you can do in order to keep the price in line with its fundamental price. It's not like equity where the price to earnings is here, the fair value price to earnings, and the price is fluctuating hugely around it. But all you can say about bonds is that they have a very low income at the moment, which means that if yields go up very quickly, the long duration bonds will make a mark-to-market loss if you sell. But as I say, if you're willing to hold those bonds for a very long period of time, the whole point of bonds is that they diversify your equity, which they've continued to do through this whole crisis, and they also preserve your capital. Again, they've done a much better job of that than equities say. So they've certainly worked so far in the crisis, and I personally think that they'll continue to do so. Somebody says, thank you for your uploads. Thank you. With bond price fluctuations with fee and buying costs, is it still more profitable in buying bonds? Well, as I say, you'd buy them for the diversification and for the lower risk and for the capital protection. That's why you would buy bonds. You don't buy bonds to get rich. You buy bonds for safety and to diversify your portfolio. I'm nervously holding cash until we have another leg lower. Is that or not sensible? It's Annabelle Franks. I mean, cash is also obviously has zero correlation with other assets and its volatility is zero. So short duration government bonds are quite cash-like, but cash obviously is the safest of all. In the UK, it comes with a government guarantee up to 85k, and so it's very, very safe. So I can fully understand why people would currently be holding cash. It certainly is, in terms of safety play, it's very liquid. By definition, it's liquid because it's already cash, and it's not correlated with other assets. One more question and I'll move on. Your thoughts on US dollar versus other currencies? So obviously we've seen a massive rally in the US dollar because in a time of crisis, usually people buy the dollar because it's a safety play. But this crisis has been no different. The dollar's strengthened a lot as a result. And as long as the crisis continues, that's likely to remain the case. So I think, you know, unless we suddenly see things change very rapidly in terms of risk appetite, it's hard to see the dollar weakening a lot from where we are now. So I'll go back now. I'll switch back to my document and hopefully you should be able to see my screen. So can you see my screen? I hope you can. Second question, what is your opinion of technical analysis? Are there any tools that automatically draw possible good buying or selling points for the S&P 500? So we've already discussed this actually on our October the 27th call. So let me just quickly say what technical analysis is. It assumes that all that matters is the price history of an asset, because every other piece of information is already factored into the price. So all you have to do is spot patterns of previous price movements, and that predicts what the future price movements will be. And these simple, and there's a whole range of these patterns that people look for. Some of them are very simple, some of them are generally more complex. The simplest would look at things like the short-term average price, which tends to move very quickly. So you'd average the price over, say, 20 days. And then you'd compare that with the long-term average of the price, say over 100 days. And then if the short term moves through the long term, which usually happens when something's trending upwards, that's a bullish signal. For example, the death cross is a bearish signal when the short term crosses the long term downwards. So that's called a death cross. Golden cross, which predicts a long-term bull market in theory, is when you've had bad news and then suddenly you suddenly get this upswing in the index or the share price, and so the short term then goes through the long term, and that signals a long-term bull market, for example. And there's a whole bunch of names for these, so cup and handle, head and shoulders, rounding bottom, double bottom, wedge, and flag. Okay, so all of these are patterns which people have identified, which they claim forecasts certain bullish or bearish signals. So the argument for this, there is no fundamental argument for this, but the argument is that this is self-fulfilling. So if enough people believe in the cup and handle pattern, then it will come to pass, right? So if they think it's bullish, people will buy and prices will go up. The arguments against it, and I've got to say, no very large fund managers use technical analysis, certainly not exclusively. If only, they might look at it as one part of a very big picture, but very few of them base their daily bread and butter on technical analysis. But what I would say is that humans are really good at spotting patterns, even in random data. And there's this beautiful example from Burton Malkiel's book, Random Walk Down Wall Street, which he generated just by tossing a coin. And it kind of looks like it's a wave. So it goes up, it goes down, it goes up and down and up. Now you could apply all sorts of technical analysis to this, but there'd be no fundamental reason to do that because it is completely random. So we can still see patterns even if something is completely random. So the danger is that that's exactly what technical analysis is doing. And there's a beautiful story from Katie Martin, who is now the markets editor for the FT. She used to just work on FX. She's been dismissive of technical analysis for a long time. And in 1994, she spotted this tweet from Suvi Platterink, which was described as the vomiting camel, right? So you can see that there's a kind of wiggly line, and then she's drawn this vomiting camel showing that the price was going down. It's a bearish signal, right? So it was just a joke. And then she thought it was a great joke, so she changed her Twitter handle to describe her as the founder and chief investment officer of Vomiting Camel Asset Management. She's even got a mug. There we go. And then what was even funnier was that in 2014, Brian Kelly, who's a presenter on CNBC, picked up on the pattern as if it was something real and described the dreaded vomiting camel pattern in gold. And there it is. There's the camel vomiting. And apparently they described this as the splash zone, right, when the price comes down. And then in 2018, you get a lot of technical analysis with Bitcoin analysts. It was also described by them. So if you want to have a look at that video, there's a link to it here. And somebody applied it here to Eurozone core inflation. And Katie says you can't use it for economic data. She's being sarcastic, of course. And she concludes that the serious lesson is to take pretty patterns drawn on charts with a pinch of salt. Personally, I'm wondering how to put the vomit back in the camel. I fear it may be too late. So personally, I don't believe in it. I'd much prefer to look at something like price to earnings or CAPE, because I think that's much more theoretically grounded. And I prefer to ground my things in things which are fairly well proven to work. So valuations have been around for a long time, and I prefer that to something like technical indicators. So any questions about that? How do you know the way to screen for companies with a lot of triple B? That's coming on to that. We're coming on to that. Okay. Greetings from San Diego. That's lovely. Thank you for that. Thank you, Sikanda Baines. Why not invest in mid-cap or small-cap index funds at 25% to 30% down? Seems better risk return compared to long-term bonds. I mean, it's certainly true that equity is now a better bargain than it was just 1.5 months ago. So the question now is, how much worse is it going to get? So if you do something like dollar cost averaging, where you just drip feed money into the market, you'll be getting much better prices now than you would have done even just over a month ago. So certainly you can start drip feeding into the market. Even if we do get another 50% correction, it would still be cheaper than it was a month ago. So if you are willing to hold for the next decade, for the next 2 decades, then certainly the prices now are better. But I think ultimately the market will recover. It always has in the past. So that's why I think it's really bad to sell during a crisis. So as I'm always telling the pension crafters, it's not a good time to sell during a market sell-off. It's a time to buy. So I'd agree that now's a good time to buy. But would I be going wholeheartedly into the market right now? Probably not, because I think we've got much longer to go until we see the full effects of the economic data. We haven't even had a quarterly earnings season, which factors in the effect of the crisis. So I'd say wait longer until we get more data. That's certainly what I'm going to do. A couple more earnings seasons before I commit more capital. Am I investing all of my ISA allowance tomorrow? I already have. So I've just put mine into my Vanguard account. Is now a good time to drip feed into Life Strategy 100? We'll come on to that question kind of in a second. And again, there are more questions about this equity. So we'll come back to that. Okay, so we'll move on to the next question because I realise it's past almost, and I try to keep this brief. If you sign up for various subscription financial services or news outlets, over time the fees can add up. The quality of the information can vary, certainly true, and may not even provide a useful benefit for a long-term investor. Can you list and review the services you think are valuable? And they give some choices there. And if it's free, all the better. So there's a frequently asked questions for the pension crafters, which has a list of these free resources. What I would say is that a lot of the data is free. So use these resources I'm about to tell you about. So Fred is a godsend, right? It's called, it's the Federal Reserve Bank of St. Louis, and it's their economic database. So that's where the letters Fred come from. And you'll see me use it in my videos all the time. So for economic data, it's awesome. It lets you download things. They come down in a nice format. You can even overlay charts. It's just great. It's amazing. I love it. The Bureau of Labor Statistics publishes US employment data. So why not use it? Non-farm payrolls comes out every month. Read the report, try and understand it. See what it means for asset prices. It's really key. Professional investors always look at non-farm payrolls because the US employment market is the most important one on the planet. There's just no question about that. Purchasing manager indices from Market. So if you click on that, it'll take you to their website, and they have a whole schedule of the purchasing managers indices. And again, I'm referring to these all the time. So these are a great way to see what's happening with the global economy and what's happening with businesses, because the place you want to hear economic news from is from businesses if you're an investor, and that's what that provides. Central banks also provide lots of fabulous information, most of which is free, because they're just falling over themselves to try and explain their policy to us. So, for example, if you look at the Fed's FOMC minutes, these are the guys who set the interest rates. There's a brilliant staff review of the economic situation, beautifully written. It's almost like poetry. Anyway, print it out, put it in your toilet, dip into it whenever you have a minute. And of course, if you don't approve, hey, it's already in the toilet. So just click on this and you can see that the latest one was here. And they talk about what's going on in markets, so development in financial markets. And they also talk about the staff review of the economic situation. A beautiful summary by some of the smartest guys on the planet. So why not use that resource? It's free. The ECB has a similar thing, and so does the Bank of England. So I look at all of them because I have to, and I kind of like it. But they publish monetary policy statement. It's on YouTube. Watch the press statement. It's great. You know, you can hear the journalists asking questions and see if you can understand what the answers are about. Over time, what happens is you find you're understanding more and more of what they say. And this stuff drives markets. It's really important, and it's free. The IMF, the World Bank and the OECD, they all publish economic outlooks. Of course they're not right? Everybody says economic forecasts are wrong. Of course they're wrong. But the point is that they have a kind of summary of the global economy, which is really useful. So just listen to the mood music. Don't listen to the particular numbers, is what I'd say. The IMF also publishes a really useful Global Financial Stability Report, GFSR. I think it's twice a year, and that's great if you want to look for tail risks. Funnily enough, they didn't mention the current one, but hey, nobody knew that was coming. Time series from Yahoo Finance are pretty good, sometimes ropey. I pay £28 a month for ShareScope. There's an affiliate link here. So if you want to try it, it's $28 per month. So I think for most people, that's probably not worth it. But if you do go for that, you get your second month of data free. And I get 2 months of free data. So I'd appreciate it if you did. But they're great. I use that for my time series analysis all the time. So I find that a very high quality source of data for indices, and I use it for currencies too. Just ETF is great. Look for ETF data. So if you ever ask the question, how do I get an ETF to do this or to do that, to track emerging markets, to track global equity markets, Just ETF is brilliant for that. So again, that's part of our frequently asked questions. We're always saying, just take a look at Just ETF. I like the FT as a news source. I used to get the Wall Street Journal, but I kind of went off their kind of quality of reporting. I just didn't like their political slant, I'd say. I didn't like. The FT is pretty good. It's pretty good. Nothing's perfect, obviously. And I go for the cheaper level of FT because I feel that's good enough for what I need. They have different levels of subscription. Morningstar's very good for fund descriptions, and it's free. And if you look at the fixed income funds, the description is great. It does the credit quality breakdown. It tells you about the effective duration, even though some fund managers, Vanguard, don't, right? So they don't tell you for some of their fixed income funds what the effective duration of the fund is, which is terrible. So I have to look on Morningstar for some of those. So yeah, Morningstar's great for that. Okay, so that was that. Let's see if any questions about that. Does Fred publish the Bureau of Labour Statistics non-farm payrolls? Yes, it does. So again, just transform it to be thousands of people change per month, right? Monthly change in thousands of people. Fred has it all for the US. It's very, very good. Do Vanguard ETFs automatically reinvest dividends, or does it go into cash? So if it's an accumulation fund, it'll be reinvested back into the fund. If it's an income fund, it gets put into your account as cash. So income gets put into your account as cash, accumulation gets reinvested back into the fund. Do I ever read investment forums? I used to look at some of the Reddit forums, but I didn't really find them particularly useful. But hey, I mean, I think it really just depends on where you are in your investment journey and what kind of quality information you prefer to have. Lancat, yes, Dylan, very good point. Dylan Reynolds says Lancat's very good for looking at platform costs and looking at platform fees. Lancat, which is an agency up in Scotland, in Leith, it's fantastic. They have a brilliant free guide to ISAs and how much they cost. So I always refer to that. I love it. And their CEO, and look at their tweets. They are so funny. If you just follow them on Twitter, it's absolutely hilarious. They make fun of their own boss on Twitter. It's great. Just joined, brilliant content. Can I access this Google Doc? So you can access the Google Doc if you're a member, right? So members can, but non-members can't, I'm afraid. So let me just go on because I'm a little bit over time and I've got 3 questions to go. So I think most people think the market will continue to go down despite the slight rebound last week. Do you think it'll move down even more? My understanding based on history is that even if you buy now, if you hold that for 3 to 5 years, you'll make some money as it'll eventually rebound. Yes, it will. Do you make some money as it will? Do you agree with this assessment, or do you think this time around the economic crisis could be like nothing ever seen before? No crisis is like anything which has been seen before. Every crisis is different. And yet after every crisis that we've had since pretty much the Napoleonic War, equity markets have rebounded. Not for single stocks, which can go bust, but for indices as a whole, which we can now buy through funds, they always bounce back. They may not bounce back quickly. So for example, some country ETFs have been languishing for a while, but generally they tend to bounce back eventually. But you have to be patient, and you have to understand that 50% falls in the equity market are just one feature of investing in equities. If you're not comfortable with that, you shouldn't be investing. But when prices have fallen, I would say is a good time to buy. But I guess the question you're asking is about how low will it go? Well, I did a whole video about that called Is Now a Good Time to Invest in the Stock Market 2020? And this is one of the slides from that. And I showed how you can split it into 2 assumptions. How many dollars are people willing to pay for every dollar of profit? That's a behavioral factor based on how excited people are or depressed they are about the markets. And it's called the price to earnings multiple. And you multiply that by the forecast earnings, which is the actual profits generated by companies. And if you look at the forward price to earnings, which is based on the forecast 1 year ahead earnings, the fair value currently, based on the 10-year average, would be about 26.58. So we're below fair value, assuming earnings don't fall 1 cent. In other words, everything is exactly as people expected it would be before the crisis. That's very unrealistic. But if that's the case, then markets, if you went back to a global financial crisis valuation where it reached 8.5 times forward earnings, the S&P would go down to 1506. If we assume you get a 20% fall in earnings, then it'll go down 20% further. So it'll go down to 1205. So those 2 assumptions would either move you down 40% from where we are now, or down even further, another 50%. But that's what I said in the video. Have a look at the video and make your own forecast. I'll show you how to do it. It's really simple. And then you've got your own view. Don't just follow other people. Make up your own mind. Okay? And then stick it in the comments or join us on PensionCraft and tell us what you think. But, you know, I don't make forecasts, but I show you how to make your own forecast. That's what I do. If you look at the CAPE measure, so this is Robert Shiller's cyclically adjusted price to earnings ratio, the typical value, the median, since a long time ago, over 100 years ago, 140 years, is 16.3 times. So if we go there, then that's 30% below where we are now. If we go to the global financial crisis CAPE valuation, that would take us 43% below where we are now. And I don't think this is the case, but if it's the Great Depression type of valuation, then we've got another 76% to fall. So if people say the index is now cheap, they've got to be making some pretty optimistic assumptions, I'd say. Personally, I think fundamentally equity could have quite a bit further to fall, but ultimately it will recover. Are we at the bottom? I don't know. Have your own guess. Look at that video and make your own forecast. What ratios do you recommend for fundamental analysis? Profitability, efficiency, liquidity, and solvency. I mean, what I would say, if you look at my latest video on the global credit crisis, which I think we're now entering, liquidity and I think liquidity is particularly important, and keeping away from leverage. So any asset which has leverage built into it is now particularly at risk, because in a recession, what generally happens is the leveraged assets tend to unravel, and that's where you'd probably see the greatest bankruptcies and companies which have the most leverage. So just be careful of that at the moment, I'd say, until we see more of the economic impacts feeding through the economy. And then we've got a better picture once the dust has settled a little bit, what's going to happen longer term. You don't have to rush into things, is what I'd say. Yeah, the Nikkei 225 did a very bad job of recovering. So did the FTSE MIB index in Italy, for example. So it really depends on which country you look at. And in those countries, so for example, Japan, there was a very bad bout of deflation, which was very toxic. We'll talk about that in a sec. Can you explain leverage? I did in my last video, so I strongly recommend that. It's called Global Credit Crisis. So that's probably one to watch. It's rather long. I apologise for that. The housing market has high leverage. Does that mean it'll be risky? Yes. And also commercial real estate. So if you look at which asset classes have sold off most, commercial real estate's got a complete hammering. So keep it liquid and keep the leverage preferably low, because those are the places where I think the greatest pain is going to be, if it's anything like 2008 or 2009. Hope you're having a good evening. Thanks for the stream. Yes, I'm having a great time. Thank you. What about leverage in Tesla? Yes, a very leveraged company. And that is worrying, right? They potentially could go bust. It could happen. But that's also why they did particularly well going into the crisis, because they were levered. But also because they make a great product, I guess. But let me move on, right? So I'll move on because we kind of need to get cracking. I've got two more questions. Given the enormous government stimulus packages, and I think there were some questions about this, what's your opinion on inflation over the next 1, 2, 3, 5-year periods? Are the government stimulus packages equivalent to printing money? And do you think it'll cause hyperinflation? So there are two effects of this crisis on inflation. Now the first one, and they're pulling in opposite directions, right? So on one side, when the supply of goods and services falls, then the prices for those goods and services increases because they're scarce. And we have seen supply fall. So try and buy toilet paper in the UK, you can't, right? So that is an inflationary force, I guess, for toilet paper. But demand, which is when how much people want to buy goods and services, when that falls, that makes prices go the other way. It makes them fall. And that's a disinflationary force. So it really depends on which of the two forces wins. Because in this crisis, we're seeing both. We're seeing a fall in supply and we're seeing a fall in demand. So really, it's a kind of tug of war between those two to see what happens. Now, typically, the Federal Reserve is terrified of deflation because in the Great Depression, the US suffered really bad years of deflation. So they hate the concept of deflation, whereas in Germany, they're terrified of inflation because they had hyperinflation during the Weimar Republic. So generally, what scares central banks tends to differ, but they're all trying to stop the economic impact being too large by stimulating the economy. So we're getting fiscal stimulus, so the government's spending more, and we're getting monetary stimulus, low rates and asset purchases, both of which are trying to help us pull out of this slump, or at least soften the blow. Of course, in 2008 and 2009, everybody said that money would become worthless. You know, people were queuing up to buy gold, but it didn't happen. We didn't get hyperinflation then, and we didn't even get inflation for a decade. I'm not saying that won't happen this time, but what I would say is have a look at this report by NISA. So it's a National Institute for Economic and Social Research. They use a simulator, which is great because it models thousands of economic variables, because for a human to understand the interconnections is very difficult, for a computer much easier. But what it does is it creates a framework so that you can start off with a set of assumptions and then it works out the consequences. So it provides a framework for going from assumption to consequence. And they've got a forecast, so take a look at their website, you'll see it. I don't know if I've got a link to it here. Is this it? Yes. So this is the report, so you can see a preliminary assessment of the possible economic impact. So that's what it's about. And what they say is that the basic net effect of the shocks tends to lower inflation. And it's really a timing thing. The only exceptions are when the periods in the reduction in demand falls short of the reduction in the supply side. And in those weird, well, kind of unusual cases like South Korea and the UK, that will create an upward pressure on prices. So it really depends on the country. And what they've done is they've shown those simulations. This is GDP, so that's growth, and this is their inflation forecasts. The dark one is 1 year ahead, red is 2 years ahead, and then the longer term impact is in grey. And what you can see is that for the UK, in year one, you get an upward pressure in prices, so that's inflation, and that's relative to the base forecast, and South Korea also. Whereas in Italy, in China, in the euro area, you get disinflationary effects, so it pushes inflation down. In the US, you get a very slight inflationary push. But as we'll see in a moment, I think their unemployment data assumptions are a bit wonky. But that's the kind of key thing. But do any of these predict hyperinflation? No. Do they predict very large deflation? No. So I think that kind of scenario is still unlikely. I mean, you can never rule anything out, but based on these assumptions, it's looking unlikely. It really depends on how long this crisis lasts. So the one which I think is a little bit questionable is the unemployment expectations. So for the US, the unemployment impact is tiny, like 0.4% of the workforce. But even if you look at the St. Louis Fed back of the envelope calculations, they're saying it may go as high as 30% unemployment. So I think these are horrendously optimistic, right? So I think they may need to recalibrate that model based on the data we've just seen on initial claims, which was above 6 million this week. So I think they may have to recalibrate their model. But I don't think we're going to see hyperinflation. I don't think we're going to see very large deflation. What will happen to the price of gold? Well, gold tends to do well during a crisis. So if we do see the crisis continue, then that's bullish for gold. Interest rates are also low, which is bullish for gold. The only thing which is slightly negative is that the dollar's strong. And of course, the gold is priced in dollars, so that tends to be a negative effect on gold. But generally, things are looking good for gold. Graham Hobbs says hyperinflation is a cert. Oh, wow. Okay. What are your thoughts on hedging using cryptocurrency? Personally, I just don't think cryptocurrency is a good hedge. If we look at the price of assets going into this crisis, equity lost about 25%, Bitcoin lost 40%. right? So it's very clear that it's a risk asset. It's not a safe haven asset. It just isn't. Long term, maybe it'll be a good investment, but at the moment, I think with those kind of volatilities, even in good times, I just don't think it's a good store of value, particularly in these uncertain times. iShares Core S&P 500 UCITS ETF at the moment. Yeah, I mean, as I say, it really depends on your view of what's going to happen to the S&P on the valuation side and on the earnings side. And I think we just don't know because we're still flying blind in terms of data. In the middle of April, we'll get some more earnings. So we'll get the Q1 earnings season in the US, and then we'll have a bit more clarity on the effects of this crisis. But until then, you know, we won't really know what the effects will be on corporate earnings. Yeah, the velocity of money is very important. So when when the government spends money, that kind of flows through the economy. And if the velocity of money is high, it has a greater effect on growth than if velocity of money is low. So that's certainly true. So printing money needn't necessarily be inflationary. That's a good point, Alex. What will be the effect on the banking sector? Well, obviously it's a negative on the banking sector because if we do get defaults increasing, then banks which make loans potentially could make some capital losses. But what I would say is that the banks are a lot better capitalized than they were in 2008. And they have done various what if scenarios, replaying a global financial crisis, and they are going to be in a better position to lend this time round because they haven't got such little equity. Right. Okay. Thank you, Roman. Pleasure, Raphael. Does bankruptcy affect indices value? Yes, because remember, for equity, if a company goes into bankruptcy, the value of equity goes to zero. So if there are a large number of bankruptcies, then for something like a small cap index, it could be significant. Plus, if default rates are high, generally equity markets are selling off. House prices are generally linked to growth, Ken Adams. House prices generally linked to growth. So if we get a recession, then house prices will suffer as a result. Also, banks are less willing to give leverage, which is effectively what happens when you buy a house. You're borrowing to invest. Banks are less likely to give leverage in a recession. So they'll probably reduce the lending ratio. Plus, people are less likely to keep their jobs because there's less job security in a recession. People are losing their jobs. So they're less likely to want to take the risk of buying a house or borrowing lots of money. So it's generally negative for the housing market when there's a recession. Crude at 50. I don't make forecasts, and I never would make a forecast on oil, even if I did. So oil's anybody's guess. But it has been spectacular how much it's fallen. And that will have repercussions too. So let me just move on to the last question. Using CAPE as a measure, there are some cheap markets out there by their own historical standards, e.g. India. Is there any point buying the S&P when it's still fairly expensive? E.g. Yeah, okay, still fairly expensive. I know your one-line answer is no, but I'd be interested to dig a bit deeper. Which markets are least correlated to US falls? So my one-line answer is to create your own estimate, as I said above. Long-term return is obviously going to be better if you're willing to hold for a long period of time, if you buy now. So you're very unlikely to time the market bottom. So the best you can do is when you think it's getting close to the bottom or you think it's starting to improve, that turning point when the market's completely capitulated, and that means nobody is saying buy the dip anymore. If there are still people saying buy the dip, it hasn't capitulated. When the market capitulates and you're sick of equity and nobody wants to buy equity, that's the time usually when things start to improve. So I'd say once you get close to that point, that's when you want to start dollar cost averaging perhaps. You know, that might be the point at which you start to allocate more. But the key thing is have a plan. If you're tempted to sell during this sell-off, it tells me your allocation for equity was too high going into it. And what I was always telling people was, to calibrate your equity allocation, assume you're going to get a 50% loss in the next decade. And when you do, have an equity allocation that ensures you don't sell. Because if you do, you crystallize the loss. But if you're constantly drip feeding money into your savings, well, presumably you'll carry on doing that now and you'll get a better bargain with your equity investments. But trying to time the bottom of the market, very difficult. But anyway, have a go at that valuation just to see what you think the valuation should be, because that'll help you gauge when is a better entry point into the market. I can't do that for you. You're going to have to decide for yourself. The only safe things I would say are not equity. So if you are going to invest in stocks, let me just make that a bit bigger. This is a correlation matrix for all of the Vanguard funds. And you can see that within the stocks, they're all highly correlated. The size of the blue blob is the correlation. And for all equity, it's very high. But where they're not correlated is with the bonds. So the only place which is safe, which is uncorrelated with equity, is generally bonds. The one market which is least correlated with the US is probably Japan. So if you do look at historical correlations, generally they tend to be lowest with Japan. Yeah, so I'd say I'll probably end it there. I'll just answer a few more questions and then I think we're done. Let me just switch here. Okay. Is there a site you can look at the leverage of companies? Well, in the latest video you'll see I talked about some ETFs which go for the quality factor, which screen for companies which don't have too much leverage. So they have high quality balance sheets, good earnings, they haven't taken too much risk in terms of leverage. So if you do want to avoid it, there's a very simple way to get exposure to that. Good evening from Salisbury. I was just wondering, with respect to valuations of the stock markets, if QE has had a permanent effect on valuations whereby they'll not fall to 2008 levels. Well, you're right, Pure Paper, that's pushing valuations up. So when you cut interest rates, the discount factors get smaller. So you're not discounting future cash flows so much. So the present value of equity rises. That's the whole thinking behind keeping interest rates low. So that's certainly a positive, but obviously the huge elephant in the room is the crisis, right? So that's pushing valuations down. So if earnings fall, there's very little the central banks can do to stop that happening. They can soften the blow, but if there's a hard economic stop, which is what we're seeing across the globe, that's very difficult to offset by just setting interest rates low or just by buying government bonds. There has to be fiscal policy. The government has to spend more. They have to bail out companies. And you also have to have monetary stimulus as well. And even that might not be enough. So I think we could still go to 2008 valuations. Good night from Malaysia, Kuala Lumpur. Good night, Gary. Oh my goodness, I can't believe you dialed in. You're still awake. You shouldn't be. Is there okay? Warren Buffett selling Delta. What do you think about that? Will Delta go under? Again, single stock stuff I never talk about. I just wouldn't be able to analyze it. I just don't have enough time to do single stock stuff, and I think they're too risky, and I can't choose single stocks. Okay, recommended financial advisors companies. Laura Nankin has written a very good article about that. So if you look at our website, there's a nice article about how to choose your financial advisor and how much it costs, which is very useful. Will this be uploaded for future reference? Yes, it will. So Yapushi, thank you for asking. Emerging market bonds, I think they'll suffer for the reasons I gave in my Q2 investment video on how I invest my own money. Particularly, I'm worried about the fall in the price of oil. So, for example, Russia is hugely exposed to the price of oil, as are many of the other members of the emerging market sovereign bond indices, such as Qatar, for example, or Saudi. So that's why I cut my exposure to that. So I think emerging market sovereign bonds are worrisome at the moment, also because they've issued a lot of debt and there's a lot of leverage there. And as I say, I think you want to keep away from too much leverage and away from low liquidity. And emerging market government bonds have both. They're fairly illiquid, relatively illiquid, and they have a lot of leverage. So I'd be very cautious about that. Okay. Right. Well, I think that's enough actually for tonight. As I say, we're going to have another call next Saturday at 7 p.m. Hopefully the Queen will not be speaking at that time, this time round. This replay will be available on the YouTube channel. So if people want to watch it again, it'll be there. And I'll make it available for the Patreon supporters. So thank you to everybody for joining us, not dialing in. And thank you for our Patreon supporters, because as I say, we really couldn't do any of this without you. So if you have found this useful and you think it might be worthwhile joining us on Patreon, it's just $10 a month. And we also have a free newsletter. And if you want to have a one-to-one with me, this is like this, but it's just the two of us. It costs just £80 an hour. So you'll find all of that on our website, PensionCraft.com. So you all need to sing God Save the Queen. Yes, you do need to sing God Save the Queen now. Thank you, everyone. Take care and good night.